Hi, welcome to IHI's Global Certification Program for Hospitality Leaders. IHI's certification will help you stand out and elevate your career. Whether you are a high-powered executive or an up-and-coming leader, your certification will announce to the world that you are equipped with the skills needed to be successful in the 21st century hospitality industry. Good luck.
Well, hello and welcome, everyone. I think this is our cue to start. Good morning and good afternoon. Depends where you are joining us from. The three of us are joining from Europe, so it's the afternoon here. But I guess everyone in the US, good morning to you. My name is Heleri Rande. I'm a hospitality strategist, writer, speaker, and presenter, and it is my honor to moderate the discussion today. We have quite a topic to cover, environmental sustainability in hospitality, harmonizing enterprise profitability and environmental sustainability. Quite a mouthful, but we'll get through it. Given that the 2021 United Nations Climate Change Conference is happening as we speak, the panel today could not be more relevant. I am delighted to welcome two industry experts to share their views on this. First, I will ask both of them to introduce themselves, and thereafter I will explain how today's session will run. Xenia, ladies first, so over to you.
Thank you, Heleri, and it's a pleasure to be here. Welcome to everyone. My name is Xenia. I am the co-founding partner of the Considerate group. We are a consultancy specifically for the hospitality sector to drive sustainable solutions for hotels and other businesses within our industry. Willy, over to you.
Great, and Willy, over to you.
All right, thank you so much, Heleri. Thank you, Xenia, and also the team behind the Global Hospitality Summit. My name is Willy Legrand. I'm a professor of hospitality management at the IU International University of Applied Sciences. I'm also located in Germany. I've been researching the field of hospitality, resource efficiency, and general sustainability for over 20 years now. I've just completed the writing of a fourth edition of a textbook. It's called Sustainability in the Hospitality Industry, 700 pages, 100 case studies. So there's a lot happening actually in the field of hospitality and sustainability. It's finally entered the boardroom meetings, and I look forward to sharing some of my thoughts here with you now.
Thank you both. The way we will structure this is we have three presentations to go through. First, Xenia will set the scene with some numbers and stats and bring us into context of what we're talking about when we talk about sustainability in the environmental context in our sector. Willy will then take over to kind of delve into some frameworks that I think are incredibly useful and really, really relevant, because we want to make sure that you get some tools out of this and something that is applicable. And then Xenia will talk through three case studies to give actual context of where change has been implemented and how that has been done and how it has been measured. And then we'll open it up to questions. So Xenia, I'll let you take it from here.
Excellent. Thank you very much. Can you tell me how I can take control for our presentation?
Maybe try share screen and then should be able to bring up your slides.
Aha, that's a minor issue because I thought you would give, sorry, everybody, apologies. I just need to open that up because I thought that was being provided here on the call. So give me 2 seconds.
In the meantime, I'm going to say hi to those joining us from the Philippines. It's a lot later there than here in London. So we do have people from all over the world, which is what this industry is really about. Let me know if you.
You know what, Heleri, why don't you share your screen then, and I will ask you to forward the slides. Can you do that?
We can do that. Just give me 1 second to make sure I have the right ones from our multiple conversations. In the meantime, someone can tell a joke as I'm pulling them up.
Or someone can see and send us any feedbacks you might have had from watching COP. I don't know whether you were tuned in to President Obama's speech yesterday, which was very emotional and got a standing ovation from all the delegates there, and I think has reinvigorate the conversations for much needed stalled discussions going on. So important to, here we go. Thank you, Heleri.
So.
Excellent.
Over to you.
All right, over to us. So we will talk about harmonizing enterprise profitability and environmental sustainability. Let me see, I think you might, can I forward it? Yes, there we go. All right, I'm giving you a few facts. So anybody who has been following COP26, we're all talking about 1.5. Why are we talking about 1.5? Because if world temperatures rise by 2 degrees, what is likely to happen is this. It will make severe heat events 2.6 times worse. We will have a bigger 2 times worse loss of plant and vertebrate species. There will be a 3 times more loss of insect species, and the decline in marine fisheries are twice as bad. Not to mention, if somebody saw potentially also the disappearance of many of the island states, which are key tourist destinations, such as the Maldives, Samoa, Antigua, Barbados, to mention only but a few. There is also a problem when it comes to open dumps and ESG factors here, because 3/4 of the largest open dumps in the world are coastal, which means absolute marine pollution. We need our marine environments because they act as carbon sinks. We also have the issue about clean and safe drinking water that affects us. At the moment, currently 1 in 9 people lack access to safe drinking water. We have currently 150 species made extinct daily, on a daily basis, 150 species. That is a huge issue when it comes to biodiversity. Again, biodiversity secures our environments, our livelihoods, our daily livelihoods, the air that we breathe, and the carbon sinks that we so badly need. So this is also based on the deforestation. Obviously, we've seen that COVID highlights possibility where we had a sudden drop last year in global emissions. It's also highlighted the possibility of working together as world communities, and I think this is a really key issue. Another issue that affects us when it comes to ESG and sustainability is the laws that do not enforce equal pay for men and women. We know that diversity is, again, badly needed to secure the future of companies. And we're also looking at issues around child labor. Again, that's something included in sustainability, and it's something that comes from our supply chains. Let us quickly look at our tourism and hotel footprint when it comes to carbon emissions. Currently, we're calculated more or less to be responsible for 8% of global carbon emissions as an industry as a whole. A lot of that is in transport, about 4% of it really. I'd just like to highlight the fact that our digital behavior has already overtaken our transport emissions when it comes to flights. So yes, we need to fly less. Yes, we need to do something about that. But we also need to come out of the corner of being flight shamed the whole time, because as we also know, we are responsible for 1 in 10 jobs worldwide, and we contribute hugely to global GDP. Other aspects of our impact is obviously solid waste. We do create a lot of waste in tourism. We need to be much more aware of how we can reduce that, especially when it comes to over-tourism, leaving waste behind. We're also a large contributor to biodiversity loss, especially when it comes to marine plastic pollution. In Europe alone, we are responsible of 27 million tons of food waste. That is not just a massive CO2 emission, it's also a cost factor. And then what we have to see is we have a crossover with the built environment, because obviously hotels are buildings and are also considered to have 39% of the global CO2 emissions. So there's a little bit of a gray zone here that Willy will be talking about a little bit more in his next slide when we come on to that. Heleri, can we go on to the next slide, please? Net carbon zero, we've all been hearing lots about that in the news over the last few days. Net carbon zero meaning that we as an industry want to obviously reach net carbon zero by 2050 latest. The Sustainable Hospitality Alliance has found that the hotel industry alone needs to reduce its carbon emissions by 66% by 2030, so that we have eight and a bit years left to do that, and by 90% per room in 2050. So the pressure is on. Again, Willy's going to talk a little bit more how we can do this. Energy consumption as a whole represents 3 to 6% of the whole hotel operating costs. So if we reduce those, we've actually got a huge opportunity of cost reduction, and is responsible for about 60% of the carbon emissions. So this is really where we need to be drilling in. Reduced energy demands means smaller, cheaper heating, cooling equipment, less strain on system, lengthening design life. So it just, as a sort of operational thing, it's really important to be looking at that. And obviously then we also have the issue around greenhouse gas removal, sequestration, where the project we can be participating in as an industry. What are the sequestration programs, which basically means the maintenance and conservation of a lot of natural assets that we can use as tourist assets also. And then we have the increasing biological update, forestation, peatland, coral reefs, bioenergy, etc. So this is an interesting field to be following, to be engaged in, and we as an industry can actually have a huge impact. The IUCN has recognized finally that tourism can play a part in conserving biodiversity and natural assets. So let's move on to the next topic. Market trends. Obviously, the consumers are demanding this of us. 58% of consumers say they're thinking more about sustainability now than before, and we see it everywhere. It's in the boardrooms, as Willy mentioned. The millennials, they're all out on the street at the moment, even camping in front of Capitol in Washington, I hear. They are really adamant this is their future. We must not take it away from them. And they're all saying they will not choose a brand that is associated with poor environmental standards or social standards. It's about attracting talent. We know that we've got a loss of talent at the moment in our industry. A lot of us have bled team members. We need to be attracting young talents back into the industry, and ESG sustainability is going to be key to doing that. 70% of the global travelers say they would be more likely to book. This comes from booking.com, knowing that their accommodation was more eco-friendly, and the market opportunities are obviously huge. When it comes to Generation Z, this is the buying power, 143 billion US dollars. So let's focus on that. And then when it comes to business travel, there is an increasing demand for RFP processes covering CSR or sustainability issues. So we hear it all the time. All the business hotels are really struggling with those RFPs at the moment. The question is, and we really need to be addressing that sooner rather than later. Otherwise, you lose a lot of your corporate travel. And I think this is it from me at this point. I know I've still got the opportunities, and again, we'll be diving into those a little bit more with the case studies. But we do have, that ESG, as we just said, they provide principles and avenues for cost savings. As I just mentioned earlier, we will be diving into the ROIs later in my case studies. Again, the market opportunities here with Generation Z. We have the issue around sophisticated investors. It's really the financial markets that are pushing for this. All the asset funds we're speaking to, they're all being driven by their investors demanding ESG, demanding sustainability in your business strategies, and to really be transparent about what you're doing. And not just that, we can also be, as I mentioned earlier, we can really be leaders as an industry rather than being shamed all the time for travel and flight shame. And we're contributing to CO2 emissions. Let's see that we play a positive role in the future narrative around climate change and become leaders in conservation of climate assets that are also tourism assets.
Thank you, Xenia. I think that was a really good setting the scene. Lots of numbers and data here. We're going to hear even more about that, but I think it was a good sort of starting point of understanding where we are and where the opportunities lie. So I'm going to stop sharing my screen. So Willy, you can take over, and there we go. Perfect. Yeah, you've got your slides up.
Ready to go. Thank you so much, Xenia, for this excellent and relevant information. And I'll pick up on net zero mostly at this point, in fact. So listen, our session is called Environmental Sustainability, Harmonizing Profitability and Environmental Sustainability. It is a mouthful, trying to get the best of both worlds, but Xenia was pretty clear in regards to market trends and opportunities. So in a way, it's a no-brainer. But however, I think if you run a business, it's still rough because you just come out of a pandemic. You may still be faced with capital constraints in regards to investment. You have limited financial resources. You're trying to stabilize your cash flow. So, that's really the premise, I think, of my presentation this afternoon or this morning. Really, we have a massive existing building stock in dire need for renovations, refurbishment, and retrofittings. And I'm not necessarily talking about the aesthetics here or consumer needs. I am talking about the imperative to reduce emissions, as we just heard from Xenia, on average by 6 to 7% per year towards a net zero. And so the question is, how do we get more bang for your buck? So Xenia already said the premise here, and I'll just shortly expand a little bit on the concept of asset value. When we look at asset value, there are ways to go at it from the building codes and from Red Book valuation, from chartered surveyors, etc. In the hotel industry, we also look at different ways of asset valuation, which may include income capitalization approach by looking at the market value through your discounted cash flows. We might look at cost or sales approach. And while those have all merits and deficiencies, other factors play a role ultimately, such as location or brand, for example. Now, we take all of this into consideration and ultimately we derive a value for your hotel asset. Now, the question is whether we're really capturing the true worth of this asset value beyond the financial component. In other words, are those assets possible liabilities, right, for society, current and future? Now, valuation standards used do not mention any requirements to consider climate risk, which means that we're not taking a forward-looking approach in respect to the physical climate risk. But as Xenia mentioned, the built environment, that contributes roughly, 40%, 40% of carbon emission. And it is under intense scrutiny by regulatory bodies, with building here in the EU being a cornerstone of the Green Deal and decarbonization efforts, for example. So in fact, if you're a property asset manager or you're an asset owner, thinking forward is about proactively working towards that value preservation first, followed by asset enhancement. And so, we have the technology, we have the know-how, we have the best practices, it's all available. We have yet to see the depth really of transformation in our industry. How many of the 6,200 hotel projects currently under construction are zero energy hotels, let alone plan as a net zero carbon building? And what about transitioning the existing supply to net zero? And so the argument, in fact, is, that those properties will join a stock of building with committed emissions in a world which, as we know, is desperately seeking to reduce and neutralize the emissions. And de facto, what we're doing is we are investing in soon-to-be stranded asset. And the International Renewable Energy Agency has a clear message to the real estate sector with an estimated $10.8 trillion of stranded assets by 2030 in a business as usual scenario. And the bulk of these stranded assets are in buildings. In Europe and the US, especially 95% of potential stranded assets are buildings, including, of course, our hotel property. Now, 85 to 95% of the building that exists today will still be standing in 2050 when we actually have a goal to be climate neutral societies. Most of those existing buildings, residential or commercial, are not particularly energy efficient. Many rely on fossil fuel for heating and cooling, and they use old technologies. We have wasteful appliances. Now, any of those can be candidates to stranding. Why? Because tenants and operators will shun those inefficient properties. Owners will be stuck with major retrofitting endeavors, keeping up with things such as carbon pricing, decarbonization requirements, and the property becomes a liability, as I said, both financially and to society. So the message here is clear. Delaying actions to decarbonize increases the risk of stranded asset. And that, is what many cannot afford to have happening. So in the EU alone, 85% of the building stock are properties that were built before 2001. The situation is similar in the US, where 60% of the hotel's square footage is actually 30 years of age and older. And with the strong American pipeline that we've seen for the past decades, more than 20% of hotels have been built since 2000, actually. But the data seems to show that these are not necessarily much greater at energy efficiency. And this is actually worrying. Now, back in the EU, we have only 8% of existing buildings. This building stock actually undergoes some level of renovation each year. But in 2020, there was a report by the European Commission. Deep renovations that actually reduce energy consumption by at least 60% are carried out only in 0.2% of the building stock per year. And so the report actually concludes, and I quote here, at this pace, cutting carbon emissions from the building sector to net zero would require centuries. Okay, so the message is clear, right? Driven by increased regulatory pressure, economic imperative, and a fair share of intergenerational justice, which Xenia was talking about, we need to decarbonize to net zero. The topic of building energy efficiency has been defined in many different ways. We look at energy sourcing and on-site, off-site renewable energy, on-grid, off-grid, etc. Basically, it comes down to, how do we make informed decisions? And so when we make decisions regarding investment, we may turn to well-established methods. We look at calculating a payback period, a return on investment, an internal rate of return, by looking at the net present value of all your cash flows. And all of those are great to use, of course, from an economic standpoint, but they provide arguably only half of the picture we need to move forward. So to better equip ourselves in making decision under that capital constraint, one should ask, what is the most efficient way to cut carbon? And so put your seatbelt on, because I'm going to explain how we could achieve that. So back in May this year, I wrote a white paper on the marginal abatement cost curve, short MAC. This methodology is really nothing new, because it was originally developed by consultant at McKinsey over a decade ago, and it was developed to guide governmental decision in terms of infrastructure development and investment. So why is this called a curve? Because in fact, it is an S curve, which shows from the most attractive investment project, that would be your box number 1 on this file, and to the least attractive project, and that would be box number 5 here. So it's actually more of a fan pattern really than a curve. And in that fan pattern, each box is in fact a possible investment project, which offers some carbon emission reduction potential. So box 2 in this case here would be, let's say, the installation of a building facade, while box 4 could be the installation of photovoltaic panel, while box number 1 could be replacing inefficient appliances to new energy efficient technologies. The height of each box represent the estimated cost of saving in euro or dollars, for example, per kilograms of carbon equivalent. In this case, the projects 1, 2, 3 are below the horizontal axis. They offer a financial saving over the investment period. Projects 4 and 5, which are above the horizontal axis, represent net costs. So when you read the graph, you have to read from left to right. The amount of carbon being abated, avoided from the lowest cost, or in this case, savings in the left, to the highest cost to the right side. And finally, the width. The width of the box represents the emission reduction potential by the project, which can be plotted as an overall emission reduction or reduced to reduction per year, for example. And that's the beauty of the MAC in a nutshell. In managing the carbon footprint of business, it makes sense to prioritize the lowest cost abatement option first under the capital constraints we're in right now. So let's have a look at the calculation formula. The marginal abatement cost is your net present value of an investment divided by the total carbon emissions equivalent abated over the lifetime of that project. So in a nutshell, it's a cost benefit calculation. Now, your net present value is really best summarized as adding all the benefits of your investment in a form of cash flows. Over the time period, you discount those to today's value and you subtract the original investment. That's net present value. The discount rate as a percentage rate represent obviously the diminishing value of cash flow over time. So setting the discount rate is often the work of your finance department, and it could be, based on the expected return from your investors or the cost of your borrowed funds, for example. Another way to look at it is using weighted average cost of capital. I don't have to go into the details. More important is, independent of the approach chosen, often a greater discount rate is applied to factor in the component of risks and opportunity costs in an investment. So the net present value, however, that gets us only halfway there to identify the lowest cost of abatement, because it gives us an idea of the project that has the highest financial benefit. It doesn't tell us, however, about the project relative emissions reduction benefits. And to figure this out, we simply need to compute the amount of tons of carbon emissions equivalent saved by each project. There really are various ways to do this. There are calculators that can be used. So once the amount of energy saved is calculated, let's say in kilowatt hours, for example, or in percentage reduction, maybe you've changed your lighting, for example, a hotelier could use free of charge methodologies that can help assess carbon footprint of operations before and after the implementation of a project. The Hotel Carbon Measurement Initiative from the Sustainable Hospitality Alliance can actually be helpful for that. Alternatively, and this is what I've done in my paper, if you have access to emission factors in your country or region, this makes the calculation that much more reliable by multiplying the energy usage, but that emission factor. And finally, the overall results is multiplied by -1. Thus, it turns a positive net present value, which is ultimately what business owners may see when all the savings or benefits over the lifetime of the project are greater than the original investment, into a negative abatement cost figure. Why do we want this? Because in the MAC, a negative abatement figures is a savings figure per tons of carbon emission abated. So from your company's perspective, you would want to have the most bang for your buck, or greater value for money, or greater cost benefit ratio. That is the most carbon abated for the least cost. So in order to, I'll spare you the entire calculation here, but let's just work out one simple example. I have here a 100-room hotel. Times are difficult, but I know I need to up my game, right, in regards to energy efficiency, which is the bulk of my operating cost per tenant. And, there's carbon market discussions that are taking place. So I wish to be ahead of the game. I cannot do everything at once, and I want to make an informed decision. So it comes down, in my case, to two options at this point. I can do a complete LED retrofitting or a photovoltaic and energy storage investment. And again, this is only for the explanations of this exercise. And so, what we do is we go and I calculate the net present value of those two options. I need to, and I'm putting the graph up here, but I'll explain in a minute. I need to retrofit 45 watts halogens to 9 watt LED. I've got 6 bulbs per room. I run 70% occupancy. I have a burn average of five hours per day, etc. On the other hand, I've got a photovoltaic with 10 kilowatt peak system with storage capabilities. But and if you're interested in calculation, it's all in a paper. But in both cases, I have access to the emission factors here, which represent the greenhouse gas emission intensity from electric generation. And my example is a German one. So the LED investment results, in fact, at 154 tons of carbon dioxide equivalent abated over the lifetime of the project, in this case, 12 years. The cost of abatement is a negative 241 euro per tons of carbon dioxide equivalent. So in this case, it's about straight savings, which basically means an extremely attractive investment with a significant amount of carbon avoided. The PV system and storage system results in roughly 81 tons of carbon dioxide equivalent avoided over that 20-year time frame, with a cost of abatement of 16 euro. In this practical example, the LED retrofitting project is an attractive proposition as it provides the hotel a negative marginal abatement cost, so straight saving from a positive net present value of the investment. The investment in a PV energy storage system results in a positive marginal abatement cost and slightly negative net present value. So for the PV investment, it would be very advisable here for the owners to actually consider, is there financial support and incentive that is associated with that generation of renewable energy that is not taken into account in this calculation? Because in the case of PV system, I've done the calculation, even a small reduction of the upfront investment capital required is enough to turn the investment into a positive net present value and a negative marginal abatement cost. Now, what other alternatives do we have here? Well, one could say that instead of investing in PV and storage system, I simply take the emissions and I offset them by investing in various, carbon sequestration projects such as reforestation. If we follow that same logic and look at the current carbon prices, for example, the carbon prices of EU emission trading scheme, which has really never consistently traded over 30 euro per ton of carbon equivalent, has now jumped to 60 euro in November 2021. This is a huge increase from the 18 euro back in 2020, and prices are expected to continue to rise. Why? Because the EU strives to meet its carbon emission reduction goals, and carbon allowances become less available. If we look at there's currently 64 carbon pricing initiatives globally, and according to the IHS Market Global Carbon Index, the weighted carbon price is currently at $41 as of November 8th. So pretend you would be involved in this carbon market. Suddenly, the 16 euro that you would pay for the PV actually becomes quite attractive. It doesn't look so bad after all. So it is all relative. And so the latest report, and I'm going to put this in the chat a little later, the latest report by EY, Parthenon, and Booking.com released just a few days ago. It's called The Road to Net Zero Emission, uses extensively the marginal abatement cost curve calculations, and they have dozens of recommendations based on net present value of investment and carbon emissions abatement calculations. And it provides exactly that fan pattern. Now, don't get me wrong here. This is just as an example. I'm not saying that electric car is better than PV installation. It's just for the example. And of course, if you think about it, much of this has got to do or is related to building structure in hospitality and facades and fixtures and equipment, because this is where the greatest potential exists in cutting emissions. This is where we can tackle asset value and the threat of stranding asset. This is not to say, however, that operations are not important. They are important, and so is employee and guest behavior. But building efficiency is a necessary cornerstone to net zero. So remember, just as I'm finishing here, the bottom equals savings, the top equals cost. Do not dismiss those necessarily. Consider what alternative you may have with investing your money. So this past week at COP26, we've seen the launch of the Glasgow Declaration on Climate Action, and that's a step in the right direction, right? Global commitment, net zero by 2050, the pathway to net positive hospitality by the Sustainable Hospitality Alliance goes beyond a straight net zero, looks at what needs to happen to make things better, because climate and biodiversity really are two sides of the same coin, in fact. And we are seeing methodologies on net zero in hotels being developed, providing a step-by-step guideline, how to set a baseline, how to set a target, how to make sure we measure and keep track. And so there's initiatives out there, there's support out there more than ever before on the topic of environmental sustainability. And so, while at the COP26, and that's going to be my last statement here, while at COP26, we hear about negotiation on budget for loss and damage and the historical responsibility of emissions, and this is still continuing, etc. But it's clear for me that the private sector cannot completely rely on governmental interventions, whether it's in terms of regulations, which, by the way, will come anyways, or incentives. If we hope to achieve ambitious decarbonization in the next 10 years, we have to take charge. I hope the MAC can help. Thank you so much.
Thank you so much, Willy, and that's a lot to digest, I think, for the audience, which is a good thing, because we need tools. Because I think we're all believers in what you cannot measure, you cannot manage. So I think this is a great opportunity to move in the right direction. We're gonna go into a couple of case studies with Xenia, just to kind of round up some of the information that's been put out there today. So Xenia, with your permission, I'm going to share the screen again with the first one. So you let me know how to manage the slides.
Yeah, I mean, this is a really brief one, just to make people understand put into perspective what Willy was just talking about, and how easy potentially it is to just identify 2 to 3 areas in the hotel. Willy gave the example of solar or LED, and to say, what are my areas? We know that energy is really the high level consumption here, and where we can have the low hanging fruits. So this hotel in Denmark invested 1.6 million euros. And the reduction of heating and energy cooling was 90%, and their ROI was 6.7 years. So that's really attractive to investors and even to banks at this day and age. If you need financing for your models, that's what they're going to be looking at. So just identifying those areas around the cooling systems, the groundwater systems. But just quickly moving on to a portfolio, we've got a portfolio case here, which is a whole asset fund. They identified how much it would cost for their entire portfolio to invest and make it ESG compliant. You can see one case study of one hotel there, how they've calculated it. But the interesting bit here is really the return of investment being 23%. I think that is something super attractive. You see the savings from the electricity, gas, and water perspective on the bottom left. You can identify your areas. You can do a step-by-step plan as to how you're going to get there in the next 8 years. But I think, again, the overall portfolio return of investment is 23%. This hotel was 18%. I think that's attractive, especially when you're looking at financial markets at the moment. And the last slide was really around measuring and monitoring. This is a hotel that we monitored all their energy consumption, and there was no hard CapEx investment on this one. This was purely using a platform, monitoring their energy consumption, training the staff on this, and even like that, and this is a very low-hanging fruit, just monitoring, knowing what your consumption are, we managed to save £97,000 in just 6 months. So the opportunities for saving even before you start calculating your CapExes and return of investment is look at behavioral changes, look at what you're consuming, understand what you're consuming, and then you start making the changes. First, the behavioral ones, those are the super low hanging fruits for everybody. And then you can start planning your CapExes. And as we just showed, the return of investments are great, and even greater. I didn't even calculate the carbon price that Willy was showing earlier, and they're really going to come in and hit us quick and fast. So be prepared for it is the message on this one, and start learning and being aware of your energy consumption. And I think I will leave it with that. You've had a lot of information, everybody, but if you want to hear more and how to do it, we are there to answer any questions, I guess.
Excellent. Let me stop the screen share so I can look at my own notes, which I've jotted down a lot. So first of all, thank you so much, both Willy and Xenia, for providing so much context. I think there's a lot to digest. One question to each of you. Am I allowed to share your slides? Because I'm sure I'm going to get that question.
Absolutely.
Willy, is that okay with you as well?
Yes, what is it? Yeah, go ahead. I don't.
Yeah. The slides can be shared after, just because
I for sure.
I am certain that this question will come. If anyone in the audience has specific questions, please feel free to put them into the chat here. We don't have much time because there was, again, heavy topic, lots to talk about, and it's not something we can just zoom through, right? One of the things I do want to ask, though, is we haven't been very good at definitions of how we are defining things when it comes to environmental sustainability and how to measure. We're seeing all these tools come into the sector, and I think what you presented, Willy, is absolutely fantastic, especially from an investment point of view. So can we first talk a little bit about offsetting versus being carbon neutral, because I think everyone is kind of racing to doing a lot of offsetting because it's the easier one. It's the one that makes most sense and maybe is a bit of a quick fix. Would like to get your ideas on that. Xenia, I know you're already shaking your head, so go for it.
No, it's just because Willy and I have had a lot of conversations about this already. There are not enough offsetting programs on the world to supply the offsetting that all the companies are promising to reach their net carbon zero goals. So we are absolutely forced to look at other issues like carbon abatement, which is what Willy's talking about, carbon avoidance, and what I mentioned earlier is carbon sinks, carbon storage. So where can we get immediately involved in conservation projects that will guarantee that carbon storage? If it's marine environments, peatlands, reforestation, anything that is within our vicinity, within our capability, is where we need to be looking at, apart from just the carbon offsetting.
Yeah, we've been looking into this. I mean, carbon offsetting definitely has a role to play towards the net zero path, but as we've just said now, it's just not a clear cornerstone. And at the end, ultimately, we might be looking into technologies in terms of carbon dioxide removal, carbon capture technologies, because we're so far down the road on energy efficiency measures, renewable energy production, and I might just not quite do the trick really on the path of a decarbonized society. So yeah, I mean, it has a role to play, but as we said, it's just not the trick really. The trick is to really look at it from, all your scopes of emissions and tackling them. And you're asking about net zero. I mean, this is another thing. We talk about zero energy building. There's a slight difference here between a zero energy building and a net zero, carbon hospitality, in fact. Because here we're not looking only at the emissions scope 1, scope 2, what you burn and what you bring in terms of electricity, but we're looking at your supply chain and the entire value chain, in fact, of your operations. And that could be anything from the food and beverage that you're getting to your property, to your employee commuting. So, methodologies are being developed on this field. There are some methodologies out there right now, but there are some methodologies being developed specifically for the hospitality, for the hotel industry. And I'm quite excited about that. It's going to be coming out next year.
Well, that's exciting. Go ahead, Xenia.
Sorry, I'm just seeing some of the questions that Matthew has put something in here as a collective effort. I think as a collective effort, it's interesting to look at what the Sustainable Hospitality Alliance is putting out there as a sort of industry calculation, because that gives an industry benchmark. It's called the Hotel Carbon Measurement Index that they put together with Cornell University. So that gives you an average of calculation that you can orientate yourself with. And there are various industry bodies just joining forces so that there is a collective impact. And I agree with you. And there was another question here that Willy just answered with the scope 3 issue around menu modifications towards plant-based options.
Yeah, because you mentioned F&B, right? So being
exactly,
one of the drivers.
Addressing your scope 3 emissions.
And Arshad is asking as well here about the big taboo in developing countries. So this is an interesting, Arshad, and I think here you may have actually a great tool with the marginal abatement cost curve, because it is both an abatement, so energy efficiency tool in terms of abating your carbon emissions, but also your net present value of an investment. So, I mean, if that doesn't make it for an investor, a developer, a building owner, then I just don't know what else to say.
Well, I think that's about it for the session, because I've just received a notification a couple of minutes ago already that we have 1 minute left. So I know that the team is running a full-on conference, which is a big undertaking. So I would like to thank both Xenia and Willy, and I'm sure you can be reached via LinkedIn, and your contact details are available, and we will share the slides through the organization as well, if anyone would like access to them. So do get in touch, and thank you both, and thank you everyone for listening.
Thank you, Heleri. Thank you for inviting us.
Thank you, Heleri. Thank you as well, Xenia, and good luck, everyone.
Thanks. Bye.
Bye-bye.
Bye.